Good morning, everyone. I'm Amy Mulholland, and I am responsible for learning and HR compliance for the Michigan Chamber of Commerce. We are very pleased to welcome TriStar Trust and Newport Retirement Services to share information about the Michigan Chamber of Commerce Multiple Employer 401k plan, MyMEP. Today, we invite you to send questions through the chat box. It's a 30-minute webinar, so we will probably get back with you with the answers by no later than the end of the day tomorrow. At this point in time, I would like to hand it over to Jane Hagan.
Thank you, Amy, and thank you all for joining us today. I am Jane Hagan with TriStar Trust Bank, and I'm joined with Dale Essemacher from the Newport Group. And so what our agenda is today is really to talk about the new provisions that were passed at the end of December 2022. And it was new legislation that was called Secure 2.0. Keep in mind, there were 92 new provisions within that act that passed. We will not cover all 92 provisions in the next 30 minutes, trust me. We're also going to talk about what the MEP is and what it can do for you. We kindly refer to it as the MyMEP for the Michigan Chamber of Commerce. We're going to talk about what the future retirement looks like and what analysts predict for the industry. We're going to talk about the roles and responsibility of the MEP, and if you are so inclined to join. Also review some of the fiduciary services that are available to you as a plan sponsor. It insulates you against liability. And then last but not least, we'll offer a free cost comparison. So if you could go to the next slide, and then on to the next slide, and I'm going to turn it over to Dale to talk about some of the changes from Secure 2.0.
Thanks, Jane, and good morning, everybody. So as Jane mentioned, there was a major piece of legislation passed at the federal level back in December 23rd in 2022. It was talked about for quite a while during 2022 and finally passed near the end of the year. We're going to cover a few of the different provisions in this legislation. As Jane said, there's over 90 provisions, and we're just going to highlight a few that are probably applicable to the people on this webinar. First and foremost, the government increased the tax credit for small employers effective in January 1st of this year. What that basically was is a startup tax credit. Well, there's 3 or 4 different incentives, but the first one I want to talk about is for startup plans. So if you currently do not have a 401k plan, what they did is they increased the tax credit to cover up to 100% of your startup / administrative costs for the first 3 years. What I mean by that is if you did not sponsor a SEP, a simple, a 401k plan for the previous 3 years, and you're starting a new plan, they could cover up to 100% of the cost for that new plan with a maximum amount of $5,000. There's a formula that goes along with that we'd be happy to talk about in detail on a one-on-one. But again, it just basically means that you could start a plan and almost run it for free for the first 3 years. So a significant upgrade from the 50% tax credit that they had prior to this legislation passing. In addition, for those startup plans, what they wanted to put is another tax credit to cover a match provision up to $1,000 per participating employee with wages less than $100,000. So again, let's say you had a company with 10 employees, 8 or 9 of them are non-highly compensated employees making less than $100,000. You can not only start a plan and get 100% of your administrative costs covered in the first 3 years, you could also match up to $1,000 per employee with all those wages less than $100,000 and get that back 100% in a tax credit. So really, it came down to a point of why would we not start a 401k plan if you don't have a retirement plan for your employees today? You don't have to pay any costs on the administrative side for the first 3 years. And not only that, you can match for those employees up to $1,000 and have that covered in a tax credit. If you're a company that has more than 50 employees, but less than 100, so 50 to 100 participants, you still get a credit, but the credit gets phased out a little bit, 75%, 50%, but it's still a nice tax credit. That matching credit also is for multiple years for when you start the plan. Next slide, please. There's a couple other provisions that are worth noting in this tax or this incentive law that was passed. Number one, is employers that sponsor a simple IRA plan can now start a safe harbor 401k plan anytime during the year. That doesn't go into effect until the next plan year, 1/1 of 2024. Before, you had to wait till the end of the year, notify participants you're terminating the simple plan. And it was just a little bit of a hassle because people that wanted to start a 401k had to wait till the end of the year, and if they forget again, now you have to wait a whole nother year. This allows you to do that with a safe harbor 401k at any time during the year. A couple other provisions worth noting. All new retirement plans are going to be required to do auto enroll and an auto increase. This doesn't have to go into effect until after 2025, but it's for any plan that started after December of 2022. So a little confusing. Let me try to clarify real quick. Let's say you don't have a plan today. You sit on this webinar, you're like, yeah, all these tax incentives, I can start a really nice, attractive benefit for my employees. Doesn't really cost me anything. However, I have to auto enroll. Well, you don't have to auto enroll today, but you would have to amend your document in 2025 to go back and auto enroll because you started the plan after December of 22. So what we're telling most employers today, you might as well just do the auto enroll today. The auto enrollment has to start at least at 3%, and then you have to increase it 1% per year until you hit 10%, but no more than 15%. So we can help you through that. Again, you don't have to do it today, but you're going to have to do it after January 1st, as long as you've started the plan today. Employees always have the opportunity to opt out. So auto enroll basically means every employee, as soon as they're eligible, we're going to put them in at 3%. And so 3% of their salary is going to be deferred to the 401k. But again, we'll send out the notices and they can opt out at any time. And so again, this is for new businesses, or there's also new businesses with less than 3 years of existence or less than 10 employees are also exempt. Next slide, please. There we go. There's also two more provisions I just want to cover real quick before I hand it back over to Jane. Number one, for participants that are aged between 60 and 63, they can do a bigger catch-up provision. So anybody right now that's over 50 years old, as you know, you can do a catch-up contribution of $7,500. What that means is that's above and beyond the maximum limit that's allowed to contribute to a 401k. So myself, I'm in my 50s, I can contribute an additional $7,500. If you're 60 to 63 years old, starting in 2025, you can up that catch up to 10,000. So you're allowed to even catch up even a higher amount. What the government's trying to do here is allow the older employees who have less time to save for retirement to be able to put more money away. So when they do retire, hopefully at the age 65, which is the normal retirement age in our country, they'll have more savings in there to be able to access in their retirement years. And then again, there's also additional incentives allowed by employers for employees to contribute, small gift cards, etc. The one thing that I don't have on the slide that I want to mention as well is in a provision in there that's for student loans. If I'm an employee and I have a student loan that I'm paying off and I'm not contributing to my 401k, but because I'm paying off my student loan, I don't have enough money to pay that off. Employers are now allowed to match my student loan payment into my 401k account. So that's kind of a nice feature. Even though I'm not technically contributing to the 401k, I'm paying off my student loan. It allows that employer to put money into my 401k, which is nice because usually that's your 23, 24-year-olds. They should start saving at the early age, but they can't afford to because they're paying their student loan. At least some money is going into their 401k account. With that, I'm going to turn it back over to Jane. Next slide, please.
So you can see with all the new tax incentives and loopholes and things, the government really wants companies to have retirement plans for the employees out there, because you can see on this slide, we have quite a coverage gap. We actually have about 57 million people in the United States that are non-government employees that don't have access to a retirement program. And surveys tell us that if people earn between 30 and 50,000, they're 16 times more likely to save for retirement if they have a plan they could do right through payroll deduction. You know, another interesting fact is that we have a third of the US workforce that is part of the gig economy. Well, what's the gig economy? The gig economy is where people do freelance work, they work part-time, they're self-employed, they do odd jobs and so forth. So a third of the nation is the gig economy, but only 16% of the gig economy has access to a retirement plan. So you can see there's kind of a coverage gap out there. And even if we look further, if we look at companies 1 to 49 employees, 45% of them offer a plan today, but that leaves 55% of plans companies under 49 employees that don't have a plan. So that's why MEPs are designed to alleviate this issue and be able to have an affordable plan for all companies. Next slide, please. Market expectations. You know, a lot of surveys have been done regarding MEPs and regarding the Secure Act and see what are companies thinking. 76% of small businesses under 99 employees are very likely or somewhat likely to switch to a multiple employer plan. And that's really to reduce the administrative and compliance cost. 75 would simply switch to mitigate the fiduciary responsibility. And again, that's where TriStar comes in as the investment fiduciary. Newport comes in as the administrative fiduciary, the role of 316, which Dale will touch on in a moment. You know, MEPs are not new, but and it will take a little bit for these to take off to become very well known in the industry. But if we look out probably 5 to 10 years, the majority of small companies will all be involved in a MEP, simply for the reason to cut cost and to mitigate those fiduciary responsibilities. And something I just want to say here is, you know, TriStar really prides itself in doing employee education on site. When we do employee education on site, we get a huge number of participants deferring more because we do annual education. So we really feel the on-site education and having employees feel comfortable in learning and saving about retirement is so, so important. So the next slide is, you know, why are we focusing on the MyMap? You know, up in the left-hand corner there is, you know, there's a lot of legislation changes. As we said, there's 92 provisions just in Secure 2.0. That doesn't even take into consideration Secure 1.0. You know, and plan sponsors, nobody wants to read this. Nobody wants to learn it. You lack the expertise. So that's why you want to give that over to the experts that deal with this every day. On the right-hand side, Simples and SEP were really designed for small companies, but we have less than 6% of companies using those today. On the lower right, you know, several states have started what they call a mandated IRA program. Those have not taken off either. And the reason for that is because they're very expensive and they're hard to understand for employees. So that's why over to the left, MEPs have really taken off. There's lower cost to administrate, fiduciary responsibilities you turn over to the experts, ease of operations, and number one, you as a business owner, focus on your core business. If you focus on your core business and build your business and make it profitable, you'll be able to continue to offer the 401k plan to your employees. And I'll turn it back over to Dale to talk about Newport Services. Next
Thanks,
slide.
Jane. Thanks, Jane. So taking a step back, we've talked about MEP. Let me just define what this is. A MEP is a multiple employer plan. And what basically is, it's a single retirement plan that multiple companies join for, as Jane discussed, fiduciary mitigation, liability mitigation, their administrative burden is lifted, as well as cost savings. So the Michigan Chamber of Commerce has put together this MEP with TriStar Trust as the investment fiduciary and Newport as the retirement services provider. It is a full turnkey solution for small and large businesses. You have to belong to the Michigan Chamber to have access to this. So if you're on the call and you do not belong to the Michigan Chamber, that would be a requirement, is to join the Michigan Chamber, as the Michigan Chamber of Commerce is the sponsor for this multiple employer plan. As you can see, this is a full turnkey solution. Newport provides record keeping and administrative services. Someone might refer to that as TPA services. We're also serve as the trustee and custodian. We also are the support mechanism for you as the adopting employer. And then as the participants, it's kind of a combination between Newport and TriStar Trust. We have a participant call center, we have a website, we have a mobile app that they can access. But really, when they have any detailed questions about their investments or their asset allocation, that's where Jane and her phenomenal group at TriStar Trust comes in and be able to assist your employees to answer and make them feel comfortable. If you don't have a plan today, we discussed the tax incentives. You are eligible for that. And obviously not only for the administrative cost, but also for the matching contribution that you may want to do in the first couple of years. If you have an existing plan, this becomes a really nice a solution that could possibly give your HR department a huge lift from their administrative burden, as well as a cost savings. We would love to do a cost comparison. We do them all the time. I think basically when it comes down to it, the more cost comparisons we do, we rarely find a company that does not save a significant amount of money from what they're paying today, especially when you look at the all-in cost of the employees as well as the employer cost of running their retirement plan. Next slide, please. We mentioned fiduciary services, and I want to talk a little bit about this today. So when you're running a retirement plan, for those of you that have a retirement plan, you are the named fiduciary on your retirement plan. In this multiple employer plan arrangement, that named fiduciary role actually gets transferred over to the Michigan Chamber of Commerce. They are the named fiduciary, which is called the 402A fiduciary for the entire MEP. They're responsible for the monitoring and making sure that the fees are reasonable for the services provided for the providers in the MEP, which is Newport and TriStar Trust. TriStar Trust acts as the 338 investment fiduciary, which is the discretionary investment authority over the plan. So in other words, they're choosing the funds. They're responsible for monitoring those funds and making changes as deemed appropriate. These funds are available, all the information on these funds are available to you. You still get to see them, but every single adopting employer in this multiple employer plan is in the same fund lineup. The 338 also will choose the plan's QDIA, which is your qualified default investment alternative. So basically what it means is if you have an employee that enrolls into the plan and they do not choose their investment options, they go into the qualified default option, which is also chosen by TriStar as the 338. Newport actually operates as a 316 fiduciary. And I know I'm throwing out a lot of numbers out there. These are just codes in the law of ERISA, which governs our retirement plan industry. So don't get confused by these, the numbers there. It's just what we use because it's the code. So as the 316 administrative fiduciary, Newport is responsible for basically handling all the day-to-day activities and administrative functions of the plan. It's a significant amount of lift off of your HR department, as well as a lift off of the responsibility of you as the plan sponsor. I'm going to go into more details on the next slide on that, but at the end of the day, by outsourcing these fiduciary services and liabilities from you as a standalone plan sponsor to TriStar Trust or Newport, it allows you to alleviate yourself from that liability. It allows you to sleep better at night and run your business and let the experts run the business of your retirement plan as we work on this every single day. So let me go into more details on the 316. If you can go to the next slide, please. The 316 services, as I said, is basically running all the day-to-day operations of the plan. This ranges from tracking eligibility for your employees as they're becoming eligible to enter the retirement plan, notifying them 30 days in advance of when they're becoming eligible, which means sending out the notices of, if it's an auto enrollment, the auto notices, the safe harbor notices if you have a safe harbor plan, sending out this summary plan description, giving them all the enrollment information. All that gets sent directly to the participant. You as an employer don't have to track that, nor do you have to send that information out. We will do that directly as the 316. We'll also store in all their beneficiary information, right? So if something happens, obviously, to the employee, we have all that information on file at Newport. You do not need to do that anymore. We also approve and implement any distribution requests that your participants may have. So they could offer, they might want to have or take out a loan, or they have a hardship, or there's a divorce settlement. So there's a QDRO notice, there's RMDs, any distribution that happens within a day-to-day. Newport will work directly with your participants to approve that distribution, and then we'll send that directly out. You'll be notified of this activity, but you don't have to do anything. This really creates a nice, avoids that conflict of interest for your HR. This happened a lot during COVID and a lot of other times of the year where there's people coming in that have financial hardships, but they're really not a hardship in the letter of the law. So it keeps HR from making an uncomfortable decision of telling somebody that they can't get access to their money because they don't qualify for a hardship. It again allows us as the experts to work directly with your participants. And then finally, another or two other highlights I want to make on the 316 services. I talked a little bit about this when you talked about eligibility, but we send out all the notices directly to the participants as well. So at the end of the year, we have to send out a disclosure notice of all the fees to all the participants. You will not have to do it any longer. We'll do that directly to the participants. QDIA notices you have to send out. Safe harbor notices you have to send out. There's a ton of notices that get sent out, are required to be sent out, I should say, to the participants annually that you're probably doing today that you will no longer have to do. We'll do all of that for you. And then finally, the 5500, which is your tax filing form, we're going to sign and file that 5500 for you. You will not have to do that any longer. So in essence, just to review, if you join the multiple employer plan, there's very little after the conversion process or setup process that's required of you. We need you to upload a payroll file to us every week or every other week, however often you do payroll. And then we're going to come back to you at the end of the year to ask you the information to do testing because your plan is individually tested. Next few slides, Jane's going to offer some information about the plan design options. Keep in mind, as an adopting employer in this multiple employer plan, you still get to choose your own plan design and your own plan provisions for your employees. Irregardless of what all the other companies inside the MEP are doing, your plan's individually designed, still individually tested. It just rolls up into a single 5500 that we sign and file for you. I'm going to turn it back over to Jane to discuss the plan designs I just alluded to.
Thanks, Dale. And as Dale said, Michigan Chamber of Commerce is the lead employer, but not every plan has to be like the lead employer. You all have options. And that's probably one of the biggest questions we get today. So every plan that we have in the MEP currently is a little different from the other. Some of the best practices here you can see of safe harbor design. This is, a contribution that's required by the IRS standards of what they allow, and it creates the plan not to be tested. Everything's 100% vested. So that is an option. There's other options you can choose when it comes to employer contributions too. Automatic enrollment, automatic increases. As Dale alluded to earlier, those things are going to become automatic starting in January 1 of 2025. All the plans that we've been putting in after January of this year have just elected to go with it right away. Because it is a great feature. We see plans very successful with auto enroll, auto increase. Eligibility, it's up to you. It's up to you what your turnover is at the company, how it works best for you guys. 30, 60, 90 days. 90 days is a very common one, and they can go in monthly or quarterly. In the age requirements, it could be 18 or 21, whatever works for your company. The employee contributions, you'll have the pre-tax category, the Roth category after tax, catch-up contributions for people over 50, and any rollovers from other plans they can put into the plan. So these are different sources that will be in the plan document. If you go to the next slide, some of the other best practices would be, if you don't do the safe harbor match, you could do a discretionary match. You could determine what that's going to be, and then that could have a vesting schedule, up to a 6-year graded vesting schedule. You could also have a discretionary profit sharing contribution from year to year. And again, that doesn't need to be decided when you set up the program. Participant loans aren't available. I highly discourage loans. If you get participants starting to take out loans, they pay off one loan, it's kind of a revolving door. Then they're not really saving for retirement. They're paying off loans all the time. But it is an option. For startup plans, most plans do not start out with loans whatsoever. And we can talk more about that individually with you. Plan distributions, in-service distributions at age 59 and a half. Those are always good to have if somebody's working part-time and wants to supplement their income with their 401k plan. Hardship distributions are determined by the IRS requirements, termination, disability, death, or required minimum distributions. So lots of options, lots of choices, and we'll spend a lot of time on plan design with you to make sure your plan is perfect for your company. So I'll turn it back over to Dale to talk just a few minutes on administration, and then we'll wrap it up.
Yeah, so real quick, as I discussed earlier, this is a fully turnkey bundled solution. You will have an assigned person on the conversion and or setup process that has ownership through the conversion or transition over to Newport. We also do the plan and participant transactions, and we do all the compliance and reporting. Next slide, please. For you, the employer, every single plan inside the MEP has a dedicated service person. So a client service manager that you have a direct dial to somebody's desk. So whether you're a startup plan with 2 participants or a $10 million plan with 1,000 participants, we have a dedicated person. Obviously, your participants have access, as I said before, to the website, to the mobile app, and a participant call center. So it's a high touch, white glove service model that's inside the MEP, no matter the size of the plan. Again, one of the big differentiators for small businesses, because they typically don't get that level of service if you had a standalone plan at, let's say, one of the insurance providers or one of the mutual fund companies. So as we wrap up, I'm going to turn it back over to Jane to just recap and talk about the advantages of utilizing the Michigan Chamber's multiple employer plan. Jane?
So this is probably the one of the most cost-effective solutions for small companies, because we take on the fiduciary risk and manage all the work for you. As Dale alluded, as we do cost comparison, we almost always find major cost savings for our clients if they have an existing plan. You know, Newport and TriStar have a deep history and expertise and a strong focus in the retirement area. You know, as far as TriStar, we're completely transparent, investment objective, unbiased when it comes to selecting and monitoring those investments. It's really important because we're evaluated by the Michigan Chamber on those continuously. And again, there's award-winning websites for the plan sponsor, the participant, the mobile app. We see lots and lots of activity on the mobile app today. So it's a very turnkey, fully integrated approach for employees and the employers. On the next slide, just want to offer to you a no obligation cost comparison. There's just a few things that we would need is your participant and your plan sponsor fee disclosures, your current fund lineup, and any fee structures that you have. And again, we can talk to you individually about those, and we'll be happy to put that together for you. It's a great due diligence report to have in your files, so you know that you're doing the best thing for you and your employees. And just to recap on the tax savings, this is a really big deal that came out January 1st, and lots of companies are taking advantage of the new tax credits. And again, 100% tax credit for plan costs, startup cost. Before that was only 50%. Tax credit up to 100% of costs for employers with up to 50 employees for the first 3 years. So as Dale alluded, this could be a program that's really free for the first 3 years. And then the new tax credit was that matching of up to $1,000 per employee, anybody with wages less than $100,000. And the credits do apply to companies with 51 to 100 employees, but it is phased out over time. And on the next slide, you will see our contact information. So please write this down, reach out to us. We'd love to talk to all of you. We'd love to do that cost comparison and just tell you a little bit more about the program and any questions or concerns you may have. And we thank you for your time today and look forward to chatting in the future. And I'm going to turn it back over to Amy to wrap it up.
Thank you, Jane and Dale, for the very informative webinar. And thanks to all of you who have participated. As mentioned earlier, the recording will be available by the end of day tomorrow. And as Jane indicated, they're very open for you just contacting them directly, which we recommend. And we hope that you enjoyed this today. Thanks so much.